David, in terms of inflation expectations, I know that energy is a very volatile component of the CPI basket. However, this recent OPEC decision to cut production by 2 million barrels a day, is there a risk it could reignite inflation?
I think, a further increase in energy prices that's substantial would be a very large problem. Exactly as you say, energy prices have an outsized importance for how consumers and businesses perceive the inflation environment, for their inflation expectations. I think it's underappreciated just how much mischief that broad, prolonged, across-the-board rally in commodity prices as the global economy reopened did in normalizing a sense that inflation is high. Over the last couple of months, we've gotten some relief in the U.S. with gasoline prices falling. You've seen on the back of that consumer inflation expectations coming back a little bit. The story is basically that short-term inflation expectations are high, long-term expectations are low and anchored. It's hard to know exactly how worried to be in that sort of situation. This is not the 1970s where it's perceived as a permanent new normal, but we do have a problem that we didn't have in 2019. And a big increase in energy prices, I think, would make the Fed quite worried about that again and make them feel the need to be a bit more aggressive on rate hikes.
David, I've got to say, notwithstanding the last two rip-snorting sessions to start the fourth quarter and, of course, October, the market, the S&P is still down about a little bit less than 25%, right? Some of your guys a couple of days ago came out with some numbers suggesting that historically, peak to trough usually ends up being about 40%, suggesting we could have another leg down. I'm not as interested in whether you agree with that or not. I guess you'd have to because it's coming out of your own shop. But I'm thinking more whether you could shed some light on how much damage this is going to have in terms of the wealth effect, in terms of retail participation in the market, all the folks with 401ks, et cetera, and how that could hurt consumption and growth.
Sure. The first thing I would emphasize is this is not a problem. This is part of the solution. By raising rates, the Fed tightens financial conditions broadly and does its part to slow growth. If we had a really strong economy growing well above the long-term trend, we'd be making our supply-demand imbalance and our inflation problem worse. So we need to tighten financial conditions. One big part of that is lowering equity prices to restrain consumption a little bit. We'd ideally like to not overdo it. I don't think we have. Our financial conditions index framework suggests that the tightening that we've seen so far this year is imposing a restraint on the economy, on GDP growth, of a couple of percentage points. I think that's fine. In the first half of the year, tighter fiscal policy played a very large role in slowing things down. That is mostly behind us. So the burden is really on the Fed's shoulders from this point forward to make sure that we stay on that low growth path. I think they need to ensure that financial conditions stay tight, that the hard work that they've done engineering this tightening that's contributed to the growth slowdown is not reversed.